Welcome to the weekly update, where I'll go over the action in the market for the week of November 25th through the 29th, and we'll see how things look for the week of December 2nd through the 6th. We had another up week, up a little over 1% with the S&P 500. On the daily charts, things are looking pretty positive right now. We have to be a little bit concerned. Are we going to go up too far too fast? On one hand, we watch our short-term indicators, which can suggest good upward momentum, but at the same time, we can hit an overbought condition. We keep a close eye on sentiment and other things like that and put it all together to see, okay, are we going up too far too fast? But for the time being, we are positive. We're in a period of positive seasonality, looking pretty good. So things are looking pretty good here on the weekly charts as well. Before I get into that, please feel free to check out the daily videos. They are available on YouTube and Rumble. They don't become public until after the market closes for that particular day. Now, I prepare the daily video before that trading session happens, but they're not publicly available until the close of that particular day that where they apply. That's where I do most of my commentary and analysis. Also, below this video and every video that I post, there's a PDF of the slides and charts. Some folks find that useful. I do post pivot points every day. These are support and resistance levels that are on the YouTube community tab. And there's a daily chart that updates each day, but then there's an intraday chart where we can see support and resistance levels that apply only to that day. I do have a private Facebook group. You're welcome to join that. Not really active, not a lot of members, but if you want to ask me some questions or have some interaction that way and you belong to Facebook, please feel free to do that. I do really watch YouTube and Rumble comments depending on when the latest webinar was. I have to go through and delete a bunch of social media expert postings on there. And I do post on YouTube and Rumble. Sometimes I have some problems uploading to one or the other platform. If you're looking for a video, you think it's about time for it to be there and you can't find it, please feel free to check out the other platform. Here is the link to the Rumble channel. Also, I have a thing called the SPX Investing Program. It's up and going now, and it's still free until the end of 2024. And I'll be rolling out a lot more things that'll be available for members in 2025, additional courses, and you have more access to me if you have any questions or things like that. There's a link that will take you to the website as well as to a video that'll talk more about the program. Here's an email address if you want to contact me. And one of the benefits is that you get immediate access to the daily and weekly videos right as soon as they are available. And the daily videos I mentioned before is the real foundation. I do all these other videos over the weekend, but they're all meant to tie into the daily video. All right, let's go back and talk about this past week. We were up 1.05% on below average volume. It was a holiday week, and then no Thursday session, and then Friday was an abbreviated session. So you put all that together, and it's below average with volume there. And we are positive and showing some really good strength right now on the daily charts, and we're showing some improvement here on the weekly charts that I'll go through. Now, we're going to get the big employment situation report coming out this week, and that is very important and could really help dictate what the scenario is as far as what the Fed does with interest rates, and are they going to continue to cut them? Are they going to have to hold off cutting them for a while? There's a lot of geopolitical things happening right now, but the market just doesn't seem to be impacted by them, at least for any length of time. And as far as our trend, we're actually starting to show a strengthening trend, not only on the daily chart, but it's starting to develop again here on the weekly chart. And it's a positive trend, and that could be longer term positive for the market. Okay, so just some bullet points here, even where I go for to get my recap of what's actually happening in the market, they didn't update things, so I kind of had to come up with my own little points here. The S&P did rise during the week, even though it was a holiday week. Bitcoin, and this is the same bullet point from a week ago, we have not been able to get above that 100,000 level. There's going to be some real partying going on if that even happens. And the geopolitical concerns, as I mentioned, really are not having much of an impact. One thing that is benefiting stocks right now is that interest rates have been coming down. The 10-year yield closed at 4.18% on Friday, where a week ago it was at 4.41%. So that's quite a bit of a drop there. And here's the chart. I've been showing this, my gosh, well over a year and a half now, just to put this in the back of your mind that the blue line, this is how inflation has been coming down. And we saw that before from 1966 to 1982. And then we were dropping down, and then we saw hyperinflation or stagflation after that. If you grew up in the mid to late 70s, like I did, well, we don't know how this is actually going to play out. But we just want to know that, okay, things appear more inflation friendly right now. Is that going to change at some point and really send inflation higher? And then we are coming down to 4.18% with the 10-year yield. We're still above the 4.02% level. So that is having a bit of an impact on corporate earnings. We will be able to update this chart next week to see what the picture is for those that are unemployed for a longer period of time. And then here we have the earnings estimates going out into the future, and this is more positive for the market. This is what justifies prices actually going up. FactSet didn't post anything on their site. They took the week off here. So looking at the intraday chart, where we ended up being a little bit negative here in Monday's session, but we were able to hit some support right on Monday, and then we bounced up off of that and were able to hold on to those gains going into the close. So that helped things remain more positive. The most positive day was Tuesday when we gapped higher. We did fall back a little bit, but then we ended up closing just a little bit off of the high. We pulled back a little bit in Wednesday's session, but it was volume had really dropped off and a lot of people were already gone. And we kind of worked off looking extreme positive in Wednesday's session. There was no session on Thursday, and then we had a pretty solid session here on Friday. We saw some selling going into the close, but we were able to get above this R2 level. And these are the levels that I post on the YouTube community tab each day. So looking at just for the 4 trading days for this week, the mid caps and the small caps did come under pressure. We're seeing a little bit of a recovery here with the NASDAQ and S&P 500, as well as the NASDAQ 100. And these include the Magnificent Seven stocks, which now that would include NVIDIA in the Dow. So the major big indexes ended up being up, with the NYSE still looking pretty positive, where the mid caps and the small caps ended up being down. Going back to the beginning of 2024, we have all of the indexes that are positive. Looking at the sectors, we had an up week. The only sector that was down ended up being energy, where we had healthcare, which has been under a lot of pressure lately. It saw a bit of a bounce back. Real estate, also under pressure, is bouncing back up. Discretionary, that's still holding up quite well. And communication, another growth area, that ended up being positive as well. But the tech sector, we want to see that doing a little bit better than it has been lately. Then on the next slide, we look at this column way over here on the right, and I sort this according to their Scooter score. The higher they are, the better looking that particular sector. We still have discretionary coming in the 90s, as well as the financial sector. Then we have a number of sectors which are in the 80s. So they're still looking strong, but not really, really strong. And we have healthcare, even with it bouncing back up this past week, it's still looking pretty negative. Here's a look at the different sectors just for the 4 trading days. Utilities saw a bit of a bounce, healthcare and staples. Now these tend to be more defensive. So we're watching that. This is what the market tends to favor when it's getting ready to decline. So we'll see if there's any more follow through in the upcoming week. Where we saw tech and materials, these are more economy driven. And then tech is such a huge area, it ended up being down. Energy's still been under some pressure as well. And going back to the beginning of the year, financials and communication are the strongest areas, followed by utilities. And we're slightly positive with the industrials, with all the other sectors being negative the way it's measured here. Then we look at this in a little different way called a relative rotation graph. And the green area up in the top right corner, these are the areas that are the strongest over the last year. where we have things like discretionary, and that's good. That's more of a growth area. The financial sector, we're not right now anyway experiencing any kind of a financial crisis, so it's been doing quite well. The industrials, which tends to be more driven by the economy as well as communication, even though it's been underperforming lately, it's been looking strong over the last year, where we see some more weakness here in real estate. And the real weak areas tend to be staples. That's a more defensive area as well. And then energy has also been under pressure. Seeing a little bit of improvement here with the energy sector. And then we have the tech sector. It's blue, so that's a little bit more positive. And then B is the materials. And then taking that same idea and then coming up here more on a spreadsheet type of an approach, where the positive areas are communication, which is growth, industrials, financial, and discretionary, another growth area, where real estate and utilities, they're more neutral right now. The things that are showing some weakness are staples and healthcare, again, more defensive areas. And we're seeing a little bit of an improvement here, but still looking weak overall with the tech sector and energy, even though it had an up week or it's been up over the last year, it's been improving lately. Now we look at the main indexes here, where nothing is really all that strong right now. You wouldn't know that. We're setting all-time highs with the S&P and the Dow. But some other areas like the transports, they're looking a little bit better, and I'll show you some charts there. The mid caps are improving. We would like to see the NASDAQ 100 doing better than it has been lately. Utilities had been strong, and even though they had a good week this past week, they've really been showing some weakness. That's why you see the yellow here with the long tail. That means it's been in a more substantial decline. Then still have the Dow Jones Composite Average. This is the Dow, the transports, and the utilities together. It's one of the stronger areas. Utilities, even though it's been weak lately, and then some of the more negative areas have been lately with the S&P 500, the S&P 100, and the NASDAQ 100 itself. And then small caps and mid caps improving, but still have a ways to go, as well as the transportation index. All right, then sentiment. We get concerned if we get to 75 or above. After Friday's close, we're at 66. This gives you a little bit more of the context where we're going up. As the market's been going up, people have been feeling more positive about the market. And so we see this sentiment gauge going up. We get concerned if we hit up around the 75 area or even above that. The active asset manager still above this 80 level, not really much of a change from the previous week, but getting a little high there. And then here's another look at that same chart, getting close up to this 100 level. That's where we start to get a little bit concerned because we use this as a contrarian indicator when even these professional money managers are buy, buy, buy. They're human beings too and have emotions. And we did see a decline here with the VIX, with the line chart as well as the bar chart, as fear has been coming out of the market. And seasonally, we typically see the VIX going down during this part of the year as stocks are going up. This is one of the more positive times of the whole year. Still looking positive here. When this black line is going down, that means the tech sector is outperforming cash. And after really spiking up, we're coming down right now with the Ridex bear bull ratio. When we're getting really low readings, that means this crowd is more bullish on the market. When it really spikes up, they're getting more fearful. The Ulcer Index still below its moving average, and we're pretty much on the moving average with the daily chart. This is an area that I've been seeing a little bit of a concern. It's the spread between risky bonds like junk bonds and the more conservative government bonds, where junk bonds have risk attached to them. Government bonds are considered to be very safe, and we can measure the spread between the two, and it's really low right now. And that's causing a bit of a concern for some folks, and we're keeping an eye on this. This is Tom McClellan, where he goes back to 1990 and says, okay, and he inverts this. This is the spread. This takes it and just flips it upside down. Sometimes this mattered and sometimes it didn't really matter. So it's really hard to get a cut and dry result when we're seeing a real low reading, which on this chart would be a very high reading. And then this also kind of mirrors what we just looked at, where it's taking that same spread and then flipping it around into an inverted chart here, where we're getting very high readings on this chart, which means low risk. We look at the VIX and take a 3-month average of the VIX, and it's going down, and that tends to be more positive for stocks. We're also declining with the long-term 253 because that's the number of trading days usually in a year. That's a moving average of the equity put call ratio. When that's going down, that is more positive. Looking at the economy, we're still under the black line with the Chicago Financial Conditions Index, so no concerns there. We did get another estimate of GDP on Wednesday, coming in at about 2.5%, according to GDP Now, about 2.5 or so percent, a little under that to the upside as far as forecasts, and about 1.5% to the downside here. The takeaway is that we're positive, and we also see that here on this chart. Because if we have negative GDP for 2 quarters, because this is measured on a quarterly basis, even though we get updates every month, the number itself is based on quarters. If we get 2 quarters back to back, that is part of the definition of a recession. And this will be updated next week, the real-time Som Rule recession indicator now. And this was updated. Let's see, I think I have, nope, I guess it wasn't updated. This was updated. This should be, the date should be November, I think 29th. I think this was updated on Friday. We're getting up here to the black line, so we are going up. But when we really get concerned is if we go all the way up to the red line. So we'll be keeping an eye on that one. And the Brave Butters, this is another quarterly measure, but it's updated periodically here. This has been coming down. When it's going up, that's when we're more concerned about a recession actually happening. As far as inflation, just we did get the core PCE that came out this past week on Wednesday. So there's a little bit of an adjustment here, but it seems to be coming in line with expectations. As far as the Fed, 66% chance that at their December 18th meeting, interest rates will be cut 25 basis points. 34% think that rates will be unchanged. And we can see how this has been changing and locking this in. And this will gyrate every day until that meeting actually happens. Then looking out to the January 29th meeting, they think that there's a 57.8% chance that we'll be 25 basis points lower than where we're at right now at that meeting. And then there's folks that think we'll be even lower than that or that we'll be unchanged from this level. But this is far enough out into the future that this adjusts, but we still like to keep an eye on it. And we can see how the things are, how they change. Where we look at here, the dark blue, that's the reading right now. Then we go a day ago, a week ago, and a month ago. So we're getting more locked into this idea of the rate cut potentially happening at the January meeting. And looking at the Fed balance sheet where it's going down over here, but as I always say, we're going up with this number. Only a government chart can do that. And then we look at the year over year change where we are going up a little bit here, but down with the number when we look at the year over year figures for the Fed balance sheet. Keeping an eye on this. This is the overnight reverse repurchase agreements just to see if this chart starts acting weird. It's not acting all that strange right now. Okay, looking at breadth, we are setting an all-time high with the advanced decline line based on price and volume. And we're also setting highs on the daily chart. And we're seeing a real expansion of the new highs and not much of an expansion of the new lows. We're trying to turn back up with the 4-week moving average and going back up here with the 10-week moving average. And we're looking quite positive right now on the daily chart as well. The advanced decline ratio is still above 0 and looking positive. We're also looking positive on the daily chart. Accumulation distribution. Now, this is longer term. We're getting kind of an extreme reading on the daily chart. We're also getting kind of an extreme reading here on the weekly chart, which means we're getting kind of far away from this moving average. And when we get too far away from it, that's what this indicator tries to measure. We have a tendency to come back to the moving average, which usually means we're going down with the S&P. So we want to be a little bit aware of this, but we can still go higher than where we're at currently. And we're seeing pretty much the same thing right now on the daily chart, even though this is a weekly chart here. As far as our trend, we're starting to turn up above the moving average. Now we're seeing that in the short term on the daily chart. We're really close on the intermediate term chart. And then here in the longer term, this could be longer term positive to see things in the short and intermediate term switching over at about the same time we're starting to see a strengthening trend here on the weekly chart, and the green line is above the red line, so that's defaulting to positive here. And looking pretty good here with the Arun indicator. The green, that measures buyers. The red measures sellers. We're pretty much pegged at the top with buyers, and sellers are decreasing, so we're going up. This down below is the oscillator. We're above zero and advancing, so this chart is positive here. Not getting a signal with the mass index. We only pay attention to this when it gets up to the red dash line and the blue line, and we're not there now. Here's a daily chart where we are setting a new all-time high on a closing basis with the S&P, and you can see how volume just kept dropping off as the week unfolded. We're positive across the board in the short, intermediate, and long term with the Keller market model, both with the S&P, the mid caps, small caps, and the NASDAQ 100. We're negative with bonds in the intermediate term, but positive in the short and long term. Commodities are negative across the board. The dollar is now switching and looking more positive on all time frames. And there's been no updates here with the Keller, with the decision point scorecard. So we're still looking positive here. Getting to the high end of this trend channel. Now, sometimes this may act as overhead resistance. You can see when we were going up really strong in 2021, we broke above that. But that also led into 2022. So we just want to keep an eye on this for right now. But we're getting up to the upper end of this trend channel. And we're just setting new all-time highs here with the pivot points. We're well above this R2 level currently. And we're looking positive here. The red line is going up. That's a 50-week moving average, and price is going up as well, and price is above the moving average. And then the moving average crossover has us setting an all-time high. The blue line's above the red line. This is a 13-week moving average above a 50-week moving average. And we're going up above zero with the McClellan oscillator. That's positive. We're also turning back up with the summation index based on price and volume, and both are above zero. So that's also positive. The Swenlin trading oscillator going up based on price and volume above zero. That's also longer term positive. And we're a little concerned here with the bullish percent index. It's positive that we're going up. It's also positive that we're above 50. When we start to break above 70, sometimes that means we could be topping out, but there could be more room to the upside before we get a really extreme reading with this chart. And momentum is trying to turn back positive here with the PMO. We're going up based on price and turning back up, lagging a little bit here based on volume. We actually declined a little bit with the PMOs that are rising, but the buy signals are going up and the PMOs that are above zero are going up. We're not getting an extreme reading here with the percent B indicator. That only happens if we close above the upper Bollinger Band or below the lower Bollinger Band, and that's not happening right now. So the momentum, we're actually turning a little bit negative on the daily chart. It's dropping below its moving average. But here on the weekly chart, we're going up with the slope and the TSI. That's pretty much flat, where it's still positive on the daily chart. But our more intermediate term, the MACD is still positive, trying to go up with the PMO and the PPO, and we're turning back up with our longer term oscillators, the TRIX and KST. And the copy curve, which is negative on the daily chart, is still positive now on the weekly chart. The force index is green and above zero and going up. That's positive. Shaking money flow, seeing a real improvement on the daily chart and quite positive there. We're also looking more positive here on the weekly chart. We're hitting kind of an extreme reading on the daily chart with the Chaikin oscillator, and it actually came down a little bit on Friday, but we're going up here after we had been declining on the weekly chart. And we're above 50 with the money flow. Same thing with the daily chart. And the rate of change going back 1 week, it's positive because we had the up week. And we're above this 20 level here with the rate of change going back 50 periods after we had been declining. And we're looking positive, maybe a little extreme positive, which could also suggest longer term momentum with the Stochk RSI. And we've been extreme with this reading now with the Williams percent R. So that's showing in the shorter term that the momentum is still quite positive, even though this is a weekly chart. And we're above 50 and going up with the RSI 14. The ultimate oscillator actually declined, but it's still above 50. The vortex, we're a little concerned about this. After having a couple of decent up weeks, we're going down with the green line and coming up with the red line, but we're still positive since the green line is on top. And this is something that I've been waiting for well over a year now, about a year and a half. We're finally crossing above the red line here with the special K, a very long-term oscillator. We don't get many signals here, but once we tend to cross over here, we tend to stay that way for quite a while. And we're not coming down right now, so we're not hitting any of these support levels currently. So when we evaluate how is the trend looking, the hike in Ashi, we're seeing open candles here, which are positive. The Kiggy chart, did I say Kiggy? I meant hike in Ashi here. The Kiggy chart is black and pointing up. That's positive. The Renko chart has open blocks. That's positive. And the three-line break is also positive. So all of our trend measurements in the longer term are still looking pretty solid there. And we're coming down, but still positive with the ease of movement based on 14 weeks. No new X's or O's were drawn. We didn't see enough of a move there, but we're still looking positive here on the point and figure chart. We're working off of a triple top breakout that was generated on September 16th. And the longer term momentum is showing some improvement here. We're improving in the intermediate term and also improving in the short term. And this is just more for fun. We did start a new cycle right around Halloween, and we started to go up, came back, and now we're starting to go back up again. And we're still positive here with the Elder's Impulse system. And each one of these bars is a week. So that's longer term positive there. This is also a weekly chart of the parabolic SAR where we have the dots underneath. That's positive. And the daily chart is also positive. Then looking at the S&P, setting a new all-time high, coming down. We set an all-time high earlier with the mid caps and looking better, but closing well off of the highs with the small caps. The Dow setting an all-time high in Friday's session and looking really solid here. The Nasdaq not at an all-time high, but still looking pretty solid there as well. The Nasdaq 100 also not an all-time high, but still in a pretty solid uptrend. Here's the QQQs. They were up 0.78%. We want to keep an eye on this because sometimes when you open and close right at about the same point in candlestick charting, that's called a doji. And you can see back here, right, as we got into July, we saw kind of a doji here before we declined. But then there's been other dojis along the way, and we just kept going in the same direction. So we don't want to read too much into that. The mid caps coming off of setting a recent all-time high. Small caps also recent all-time high here. And the Wilshire did set a new all-time high on Friday, another broad market measure. The NYSE setting an all-time high. Big software companies, not an all-time high, but it's kind of strange. They actually have this at zero. The 4 versus 5 trading days of the week kind of might be messing with some of the charts here. We are looking really solid with all stocks. These are US stocks and world stocks together. The FANG index near an all-time high, but it was actually down a little bit on the week. ARC ended up being up over 3% and is back into a longer-term uptrend after chopping sideways for a couple of years. And the bank index still looking really solid when we look just at the chart itself. We're getting a little extreme here with the RSI. That's longer term, but the momentum continues to be positive for the bank index here. And then we look at traditional Dow theory, setting an all-time high with the Dow. The transports are improving quite a bit. Utilities, after coming back down, have now been starting to go back up. And then seasonally, looking, actually, I should be switching this over to December. The arrow should be over here, where we're up 75% of the time with a 1.6% return if you go from 2020 to current. Then looking at the broad market, kind of chopping around with commodities right now and showing a slight, well, it depends on how you look at this. This is still longer term positive, but in the daily charts, we're still in the middle of commodities are not quite sure what they want to do right now. We're watching oil. We always watch it, but this is dropping down because there was a ceasefire between Hamas, Hezbollah, and Israel. But I'm already reading reports where that's been broken, so we'll have to see if that has an impact on oil. Copper, another gauge that we use to look at the economy, still in an uptrend longer term, even though it's been pulling back lately. Gold setting recent all-time highs, but then pulling back, dealing with its 13-week moving average. Also, we were down this week with silver. And then we look at the dollar, which is just getting ready to generate a golden cross here longer term. It's just been screaming up, even though it had not a very good week this past week. We're also starting to see a golden cross on the daily chart and seeing some improvement here. When interest rates are going up, that means bond prices are going down, but they're still hitting some resistance at their 13-week moving average. But we look at the monthly chart of the stock to bond ratio. This is still, for years now, has been showing us that stocks are outperforming bonds. This is a daily chart of the yields where they were really coming down. Then the Fed comes in and cuts rates and interest rates go back up. Now we're starting to see them fall, and that could be more advantageous for stocks. This is a weekly chart looking internationally where rates did fall in the US, UK, Germany, and down just a little bit in Japan. Then some relative studies, the intermarket analysis. You have gold just slightly outperforming stocks. That's the black line. The dollar coming down a little bit here, but still looking pretty good. Oil is the red line. Bonds are improving based on price, but they're still negative year to date. Let me look at some ratios. The S&P 100 is still outperforming the rest of the S&P, which is the S&P 500. And the Nasdaq 100 is underperforming the S&P 500. We saw it top out over the summer, and since then it's been underperforming. It would be more positive for the Nasdaq 100 and the S&P for the Nasdaq 100 to be outperforming, but it hasn't been doing that lately. We are still seeing where growth is outperforming value, and that's longer term positive there. And then we do a ratio between gold and the US dollar, where this ratio was coming down as gold was coming down and the dollar was going up. Well, this past week it did bounce up just a little bit. And then we look at the gold to S&P 500 ratio, really chopping around, but in an overall uptrend longer term, showing that gold is slightly outperforming. Bonds are underperforming stocks when it's bonds based on price. The energy to tech ratio is still showing that energy is underperforming tech. Discretionary is really improving, and this is really helping the market too. It's seeing a recent golden cross here when we look at a ratio between discretionary and staples and low volatility to stocks. Bouncing back up lately, but still in a longer term underperformance with this ratio. And we look at small caps to the tech sector. Small caps have been coming on. Tech have been kind of weak lately. That's why we're seeing this ratio going up. But longer term, there's still a lot of work left to do for the small caps to start outperforming. Then long term here, we have the NYSE breadth thrust, where it was down in the previous week, and we did bounce up just a little bit here. This is longer term. And the ZWAG NYSE breadth thrust, no recent signals here, but still looking positive. This is a weekly chart of the S&P going back to the 1987 crash. We're well above this trend line. And this is that same trend line, but just going back to the end of 2018. And the weekly chart of the NASDAQ 100 still above this trend line going back to 2009. Now we have come down and we're still at the 8 level with the Zoharchak method. To be more positive, this would have to go all the way back up to 10. So we just want to keep an eye on this, but this is very long term. This chart goes all the way back to 1980. And then we look at a ratio between the NASDAQ 100 and the Dow. Both have been doing well with the Dow setting recent all-time highs, but the NASDAQ 100 has been holding up fairly well, and we're still at this very high level. And then we look at the NASDAQ 100 is represented by the QQQs and the small caps. We are coming down a little bit as the Qs have been underperforming. And if this continues to drop, that's going to cause some concern. But if this starts to go back up, that would be more of what we've been seeing lately with this ratio. And then we look at a 50-period moving average of the new highs, new lows for the S&P. They're going up, and we're well above zero. That's longer-term positive. We look at the NYSE new highs, new lows, and this red line is a 50-day moving average here, and that's still positive and going back up now. We keep an eye on the 3-month yield, even though it's been coming down lately. We're looking at a different context of when it really started to fall back in 2007 into 2008. This was the whole great financial crisis. That's why we watched the bank ETF and the financial sector, and we watched this. If this is falling for different reasons, that would cause us more concern. This is falling now more because interest rates have been coming down for the most part, especially with the 3-month. Then we look at the cumulative new highs and new lows for the NASDAQ after declining for years is now starting to go back up. And then we have this thing called the Hindenburg Omen. And if you're not familiar with that, you can pause this and just read through it. There are 3 points of criteria that need to be met before a Hindenburg omen, and Hindenburg, oh, the humanity. Well, we've only hit one of those signals right now, and that was back on November 20th. We need to see another spike up here on or before December 19th. And if we don't see it, then this spike falls off the books. We did have another confirmed spike here, but it didn't really lead to anything. So we just want to pay attention to this. Then, as far as seasonality, I have a whole lot of seasonal charts to show you. December is up 72% of the time, which is not 100% of the time. And we have a 1.3% average return. And the whole period from November through April, that's the strongest time of the whole year for the stock market. It's 6 months. And we compare the non-presidential election year, which actually outperforms the election year, but they're both pretty positive, especially after the election. This is another look at that going back to 1984, how both tend to perform quite well. And then I shifted this box a little bit forward where we're still into a period of positive seasonality going back to 1950 here. Then December is positive. Now, not as positive as November. And we had a really good November. I think we were up over 5% within the S&P 500 for the month. So we'll see if something like that can continue. We're up 75% of the time in December, going back to 1950. Also looking a little bit stronger here when we look at everything together on a world basis. December ends up being stronger. And then we take November and December together, where they're both strong based on this chart. And then November to January, where we do see good solid returns here. And then this is the whole quarter, the fourth quarter, where we're up almost 80% of the time with a 4.3% return for the quarter. And then we're shifting this around a little bit. The first half of December is positive, but it's the second half of December that tends to perform better on a historical basis going back to 1950. And here's a Carson chart showing November and then into December. We don't go straight up, but we tend to see positive seasonality here going back to 1950. We were really focusing on September, October, which tend to be weak, which didn't happen this year. Well, November ended up being quite strong. We'll see if December has the ability to also be strong here. And then this is looking at December in a number of different ways. Going back to 1950, that's the kind of yellow goldish bar here. The past 20 years is the blue, the past 10 years is the green, and then during an election year is the dark blue or black, whatever color you see there. We're positive across the board, no matter how you calculate this. And then comparing November and then December ends up being strong here, according to Carson, but not necessarily as strong as November and not as strong as October was, according to what they found out. Then this also looks more just across not only the S&P, but at the Dow. This tends to be the third best time in December from 1950 to 2023, where even the small cap. Now, the Russell 1000, those are large caps. Russell 2000, those are the small caps. And we tend to see good solid returns, up 74.3% with the S&P. The Nasdaq's up a little bit over 60%. You have the big large caps up 75%, with the small caps also up over 75%. And then you can see the corresponding returns that we get for that period. And this is also just going back to 1950 in December. We're up 15 out of 18 times during an election year. We're only down 3 out of 18 times with a return of 1.3%. So thank you. I hope you found this helpful. I hope you have a really good holiday weekend, and I will talk to you in the next video.